Hello and welcome to Gold and Silver Assets. I'm Diora and it's Sunday the 11th of July 2021. We've increasingly been hearing the term Crackup boom, and I have to admit that before this year I actually didn't know a lot about it. Today we're going to look into what a Crackup boom actually is and try to determine if we are actually in a Crackup boom, and if so, what stage of the boom are we in? The concept of a Crackup boom came from the Austrian economics and was described by von Mises, who called it Katastrophenhauser. The first thing to remember is that it's not a real economic boom, it's fake. Why do I call it a fake boom? Because one of the features of a Crackup boom is that the economy does not do well and it languishes in recession or even depression. During a Crackup boom, there's rampant printing of currency and rampant credit expansion. Another feature is accelerating inflation expectations by the general population. A Crackup boom can only occur in a fiat currency system. Well, right now, the whole planet uses fiat currency, and that's historically novel. My impression is that hyperinflation and Crackup booms are actually synonymous. Correct me if I'm wrong on that. That's just the impression I get. If that's the case, then this figure shows how the number of currencies experiencing Crackup booms increased substantially since 1971. One argument that I hear quite often is that, oh look, all those currencies are minor currencies and they don't really have an important role in global trade. And of course, the US dollar, being the world's reserve currency, makes it immune from hyperinflation. I would tend to disagree with that. Look, at the end of the day, fiat is fiat, and therefore it's only truly backed by confidence. My video about how currencies die showed that fiat currencies either hyperinflate or they get replaced one way or the other. Being the reserve currency, from what I can tell, is that it provides more leeway. It keeps the show on the road for a lot longer. But I don't believe that it really makes it immune. From what I've read, my impression is that a Crackup boom has three main phases. In the early phase, asset prices rise and people who own assets feel richer. So this is the feel-good phase. In the mid-phase, increasing proportions of the population conclude that inflation is not temporary and that the currency printing will continue in ever-increasing amounts. As a result, inflation will accelerate and the nominal prices of everything keep rising. In the late stage, the population completely loses faith in the currency and they do everything they can to exchange the worthless paper for real goods. What things occur on the journey through the Crackup boom? Well, in the early phases, there are labour shortages and commodity shortages. Consumer prices start to inflate and the economy struggles and bankruptcies occur. The response to all this is more currency printing and credit expansion. As a result, both inflation expectations and consumer prices accelerate upwards. And this basically leads to a vicious cycle and things get worse and worse. Once hyperinflation occurs, the population actually abandons the currency and they tend to adopt other forms of money. Usually this involves a black market. Printing more and more currency has no stimulating effects on the economy at that stage. Here's a quote from the book Human Action. Once public opinion is convinced that the increase in the quantity of money will continue and never come to an end, and that consequently the prices of all commodities and services will not cease to rise, everybody becomes eager to buy as much as possible and to restrict his cash holding to a minimum size. And how do crack-up booms end? Well, they end in currency and credit collapse. Any attempts to replace one fiat currency with another fiat currency only provides a brief reprieve, and it's doomed to failure. So what assets perform the best during a crack-up boom? Well, the answer to that is given in more detail in my previous video on asset performance in inflation and deflation. But here's a summary of the kind of asset performances with different figures if we use the official CPI. Basically, gold and commodities outperform, particularly in the final stages. One question that I had was, what's the difference between a melt-up in a bubble and a crack-up boom? Well, there's certainly a lot of similarities between the two. In particular, they both involve a stampede by the crowd, and there's a lot of FOMO involved there. In both cases, the rise in the asset price is not necessarily related to fundamentals, but more to do with crowd psychology. The big difference, though, that I can see is the loss of faith in the currency that occurs with a crack-up boom. You don't necessarily see that in a standard bubble. This chart shows the performance of various assets in the late 1990s and early 2000s. We can see that with the Nasdaq bubble, there was a huge melt up over here. I mean, this price movement was practically vertical, and there was a huge gain in price up there. Now, this bubble was actually localized to the tech sector. There was no such melt up in the S&P 500 as shown by this blue line, and gold and commodities were actually pretty flat as shown by the yellow and orange lines here. Inflation was stable also around that time. It was around 2%. And as far as I know, there was no kind of abnormal, out of the ordinary currency printing. This shows how conventional bubbles tend to be localized, and they're not really related to a loss of faith in the currency. So my impression is that in a crack-up boom, all assets rise in nominal terms, and the rises are not just localized to one or a handful of particular assets or sectors. And so I think actually we saw something like that last year when pretty much every asset went up in value, or in price, nominal terms anyway. In conclusion, the question was, are we in the process of a crack-up boom? Well, I think we might well be. The economic and financial environment at the moment does seem quite different to what we've been used to. And I've heard quite a few financial professionals, including some of our viewers, who have said that they haven't seen anything quite like this before, and they've been working in the industry for decades, so they're highly experienced. It's quite difficult to know exactly what phase we're in. It's quite a subjective kind of concept here. But all I can say is that I think we are closer to the early stages than the final stages right now. As the crack-up boom progresses, gold and commodities increasingly become the lead performers. We should also consider a crack-up boom to be a different type of bubble to the traditional asset bubbles that we've been used to hearing about. Instead, this bubble hinges on the loss of purchasing power and confidence in fiat currency. Next up, the market update. Let's start with gold prices in US dollars, and I think we'll look at it on the weekly scale. It's been a good week, really. We've got a nice green candle here. So, yeah, I'm not too stressed out yet. As we know, we're basically hoping for this long-term trend line to hold. And we actually haven't even touched it this time before turning around. So I think that looks promising. And we're also looking to break this resistance here from this downtrend. We still haven't made a higher high here. So over this time scale, we are still in a downtrend. But the good news is that we have made higher lows so far. So, well, basically we're in a sideways movement really here, aren't we, for kind of at least the last 6 months anyway. So at the moment, we're kind of getting close to that trend line there. So we're looking for that to break to the upside, hopefully. Now, look, this could hover around here for a few days. What we don't want is for this trend line to break. And this is the kind of the primary line that we're going to be looking at. And yeah, hopefully it doesn't break. I don't think it will. And we'll look a little bit more closely at gold on the daily scale. And so this was that upper trend line that we were looking at, and it actually pretty much hit that trend line, got knocked back, but it's kind of recovered a little bit. And so the other thing to notice here, so over here we made a lower low, but on the RSI we've got some divergence there. So in the short term it's still looking okay, and we've got plenty of room above for this to break out. Now, of course, once we get above this, we are going to have a couple of hurdles here. So around this area here, 1840, because of all this price action, and around 1880. So it could be a little bit messy around here, but it depends what happens in the week. Now, we do have the CPI figures coming out in the US on the 13th of July. And that could be quite interesting. I've heard some rumours that it's going to be high. So it'll be interesting to see what happens in the markets. Okay, let's move on to silver priced in US dollars on the daily scale this time. And with silver, this is the trend line we're looking at. So those two lows from here and here, that's what we're working with. And we never really touched that line again so far. We're just kind of shy of that, and it's kind of consolidating sideways still. I was hopeful when price moved back into this zone here, but it just got knocked back again below. And that's a really important level, that $26 level. And it has been important for quite some time. We really need to start moving up pretty soon to get back into this zone here. And what we don't want is for that line to break. Now, with silver, as I said, it's a bit crazy. It does things to shake people out. It's very wild. And so can this break? It can, but that doesn't, I don't think it necessarily means that it's bearish because of the way silver just behaves. And so that's why I'm primarily using the gold as the model for whether we're in the bull market or not, because silver can just shake people out really quickly. You could get a big wick coming down and then it can bounce straight back up again. So just be wary of that. I wouldn't use this line as a hard and fast kind of rule. I'd keep looking at the gold. And again here we had a kind of slightly marginally lower low here, but here we had some nice divergence again. So still looking reasonable, and we've still got room on the upside on here, but we want to really get into this zone here. Now I know people are kind of, they want some fast action here with a kind of explosive move. I don't think that's going to happen for a while yet. We've still got a while before I think it's going to get above 30. We're talking months. So it's just silver, you just got to be patient. And the thing with silver and gold as well is that as we've talked about a few times, it's got this tendency for parabolic moves, and that basically means that the biggest moves happen in a very, very short time. It's a kind of blink and you'll miss it situation there. Last week, one of our viewers came up with an interesting observation, so I thought we'd discuss that a little bit. So what they had noticed, which I hadn't actually looked at before, so well spotted, this was the link between the US dollar and silver, but they talked about inverting the US dollar. So if you can see here, the numbers are upside down basically. And it's very interesting actually. If you look on the daily scale, so I've drawn the US dollar in green here, and in grey is the silver price. And actually since March of last year, it's really, really kind of closely correlated, isn't it? And why is that? And I mean, normally people look at gold and the US dollar, but is this something that's been the case for a long time before? So let's have a look. So I've looked at this on the monthly scale this time, so we get a longer time span. Now on TradingView, the dollar index only goes up to 1986, which is a bit of a shame. I would have liked to get that 70s time period on that, but I couldn't get a chart that goes far back enough for that. But what we'll see here is that not so much looking at the chart, but actually looking at the correlation coefficient. So remember that I've inverted the scale up here, but in reality they are negatively correlated. So if we look here, the actual value currently for this correlation is 0.96. And actually, if you look at it, that's the most correlated, or most negatively correlated anyway, that silver and the dollar index have been in the history of this chart. It's never been that strong before. And I had a look at gold, and for gold, that correlation, gold to DXY correlation is currently about 0.7-ish. So actually silver and the US dollar are much more linked up. Why is that? I don't know. I just thought that was a very interesting observation there. Why is silver more correlated to the dollar index than gold right now? And particularly, why is it more correlated now than it's been for decades? Interesting question. Now, of course, it doesn't mean that that correlation is going to stay, because obviously, you know, these things change. You can see that it flips. Sometimes it can be positive as well. So, you know, don't expect this to stay like this long term, but it's just something interesting to watch for now in the shorter term. So that means that it's right now worth looking at the dollar index here if we're looking at the precious metals. And so this is the dollar index on the monthly scale. And we were talking about this being a rising wedge. And we had that breakout last year down below it, and then it basically went up to retest that trend line there. It got rejected, and it's kind of making its way back up there. Now, I actually found, I didn't realise that they've got a parallel channel tool on TradingView, which makes things much easier. Before I was kind of drawing a line and then cloning it and moving it, but actually you don't need to do that. So I've been using that tool lately. And anyway, so I've drawn a parallel channel to join these lows here, and so far for the upper channel we've only got that one touch there. But if you notice, you get the intersection right over here, and that's around 93.6-ish. So I don't know if we are going to go further up in terms of the dollar index. There is a little bit of room though still, so there is potential for one more up move. But I think this is going to get rejected again. And I think we're going down, down, down. How far down are we going to go? Well, I actually think we're going to end up at 84. There's probably going to be a bit of a bounce at 88. And the reason I say that is that we've got this here, and 84 is over here. So we've got kind of strong support at those 2 points there. But if that is the case, that could be what propels the precious metals upwards. So yeah, it's worth keeping an eye on that. Okay, and then we'll move on to the gold miners. This is the GDX on the daily scale. And yeah, not much has happened in the past week, really. You were kind of moved up a bit, moved down a bit. Last time we were talking about the divergence. So over here we had a lower low, whereas in the RSI we had a higher low. And the price moved up a little bit and then it dumped again. It didn't quite reach that low, but actually the RSI is kind of continuing to move up, which makes me think, at least in the short term, we're going to go up. And I think we're going to try and fill this gap here. Once we get to about 38, we'll just have to see what market conditions are. I mean, you know, there is a chance it could turn back down again because, of course, we are still in that downtrend. It's kind of a similar situation to gold, basically. But in the short term, I think we're going up still. And so just watch for that gap to be filled in the next kind of week or two, basically. And then we're looking at the silver miners. This is on the daily scale, SILJ. Now, this was interesting because last week I had pointed out how this gap hadn't quite been filled. It was close, but just didn't quite fill it. And then price had moved up. And I thought we would probably keep moving up to fill this gap, but no, it just couldn't quite make it and turned back down again. And actually that gap has now been filled, so that's good news. The other thing, last week we didn't actually have divergence here. We had that lower low here, but RSI was the same. But good news here is that now we do have an even lower low there, and we've got that divergence over here. So now what we're seeing is that divergence in precious metals and in the miners. So I think that's a hopeful sign. And again, you know, we're in that, getting into that oversold area for a lot of these things as well. So these things just make me think that we're going to move upwards, and I think it's going to want to fill this gap. Now, this has been very, very long and boring. I keep talking about that. I wasn't actually expecting this to come back down yet again, especially not all this low. And so, you know, if we go back up, well, look, I can't, I don't know how long this sideways movement is going to keep going. And look, if we get up here, yeah, it could well come back down again. But note that we've had 2 breaks of this upper trend line now. So maybe we're going to be third time lucky. Who knows? Fingers crossed. Well, that's it from me for this week. We've had some Antarctic blasts of cold air coming into New Zealand here. So I hope the New Zealanders out there are cozy and snuggled up and warm while you're listening to this. The rest of you, you're probably sweltering in heat. So I hope you got a nice cold drink with you. Anyway, that's it from me. See you next week. Bye.